Overvaluation is one of the quietest ways a business sale gets damaged, not because it creates immediate conflict, but because it weakens the process before the seller fully realizes it. A business owner comes to market with a number in mind. Sometimes that number is based on effort, sometimes on emotion, sometimes on years of sacrifice, and sometimes on loose comparisons that do not reflect how real buyers evaluate businesses. That is where the problem starts, because buyers do not pay for effort alone. They do not pay for history by itself, and they do not pay for what the owner hoped the company would become. They pay for transferable earnings, growth potential, risk profile, operational quality, and confidence in future performance. When a business is overpriced, the first thing that suffers is credibility. Buyers begin questioning whether the seller understands the market, and once that happens, serious engagement becomes harder. Strong buyers may step back early, not because they dislike the company, but because they do not want to spend time chasing a process that feels disconnected from market reality. That weakens the seller's position immediately. Another problem is lost momentum. An overpriced business often stays in market too long. Interest cools, questions increase, and the market starts signaling that something is off. That creates even more pressure. Overvaluation also creates tension in negotiation. Even if a buyer stays interested, the gap between seller expectation and buyer reality has to be closed. That often leads to frustration, retrading, or a deal that never fully comes together. And if diligence reveals more risk than expected, the number becomes even harder to defend. There is also a strategic cost. Overvaluation can distract the seller from the real work of maximizing value. Instead of improving preparation, reducing risk, strengthening positioning, and creating buyer tension, the seller becomes focused on defending a number. And defending a weak number rarely produces a strong outcome. The core lesson is simple. A business is not worth what the owner feels. It is worth what a qualified market will support under a disciplined process. That does not mean sellers should undervalue the business. It means they should support value properly, position the opportunity credibly, and go to market in a way that attracts serious buyers instead of resistance. Because in the end, overvaluation doesn't just affect price. It affects trust, leverage, timing, buyer quality, and the probability of getting a deal done. And that's why it becomes such a silent deal killer. Business Brokers. We represent you in business sales and acquisitions. Confidential, structured, executed.